Financial simplification equals mental clarity. A behavioral and psychological analysis. Modern investing often promotes complexity. Multiple accounts. Dozens of assets. Constant monitoring. Tactical adjustments. Market news consumption. Yet research across psychology and behavioral finance suggests something counterintuitive. Financial simplification often leads to mental clarity. Let's explore why. 1. Cognitive load and decision fatigue. The human brain has limited decision-making capacity. Psychologist Roy Baumeister introduced the concept of decision fatigue, showing that repeated decisions reduce mental energy and self-control. In complex portfolios, investors must constantly decide. Should I rebalance? Should I sell? Should I hedge? Should I switch funds? Is this sector overweight? Each decision consumes cognitive bandwidth. Simplification reduces decision frequency, and therefore preserves mental clarity. Less friction. Less noise. More focus. 2. Complexity increases anxiety. Uncertainty combined with complexity amplifies stress. When portfolios contain overlapping assets, tactical trades, short-term strategies, leverage, the monitoring burden increases. Behavioral economist Daniel Kahneman explained that humans rely on fast, emotional thinking, System 1, under stress. Complex systems overwhelm analytical capacity, System 2. Simplification reduces monitoring stress, analysis paralysis, fear of missing hidden risks. Clarity improves emotional stability. 3. Volatility perception decreases with distance. The more frequently you check prices, the more volatile your portfolio appears. Research in behavioral finance shows that increased monitoring increases perceived risk. This amplifies loss aversion, emotional swings, impulsive behavior. Simplified investing often includes fewer assets, clear allocation rules, less frequent checking. Distance reduces emotional noise. 4. Identity detachment. Complex investing often encourages identity attachment. I'm a growth investor. I trade macro cycles. I rotate sectors. Simplified investing reframes the role. I allocate capital based on long-term probability. Less identity involvement reduces ego-driven decisions. When portfolio equals tool, not personality, mental space expands. 5. Research on trading frequency. Studies by Barber and Odeen found that higher trading frequency correlates with lower average returns. Complexity often increases trading. Trading increases transaction costs. Emotional reactivity. Overconfidence. Regret. Simplification naturally reduces activity. Less activity often means fewer mistakes, lower stress, more consistency. 6. The minimalism parallel. Psychological research on minimalism and decluttering shows reduced physical clutter lowers stress. Fewer possessions reduce cognitive distraction. Simpler environments improve focus. Financial clutter behaves similarly. Too many positions. Too many strategies. Too many what-if scenarios. Simplification is financial decluttering. Mental space increases as structural noise decreases. 7. Long-term frameworks reduce mental friction. As argued by Burton Malkiel in A Random Walk Down Wall Street, markets exhibit strong randomness in the short term. Complex short-term optimization often adds stress without improving expected return. Simple long-term frameworks, e.g., broad diversification, low cost, periodic rebalancing reduce forecasting pressure, tactical stress, performance comparison anxiety. Mental clarity improves when prediction pressure decreases. 8. Emotional sustainability. Wealth building requires decades of discipline. Complex strategies may look intelligent, but sustainability depends on emotional endurance. Financial simplification supports sleep quality, reduced checking behavior, lower volatility perception, more stable expectations. Calm investors are more consistent investors. Consistency compounds. 9. Opportunity cost of attention. Every minute spent analyzing charts, Watching financial media. Monitoring short-term movements. Is a minute not spent on career growth, relationships, physical health, creativity. Simplification frees attention. Attention is finite capital. Protecting it is a form of wealth preservation. 10. Redefining optimization. Many investors confuse complexity with optimization. True optimization may mean clear asset allocation, limited fund selection, automatic contributions, infrequent rebalancing, defined time horizon, optimization of system, not optimization of every fluctuation. Clarity is efficiency. Conclusion. Financial simplification often leads to mental clarity because it reduces decision fatigue, lowers emotional volatility, minimizes action bias, preserves cognitive bandwidth, improves long-term discipline, protects psychological sustainability. In the end, complex portfolios stimulate the brain. Simple portfolios calm it. And in long-term investing, calm behavior is a competitive advantage. Because clarity compounds. Just like capital.